Okay, I am back, and let's see what happens. So we're going to see if we can get some new questions here. I'll see how long I can go before I lose steam. So I go to, if I want to try the practice exam, I go to FINRA, and all I did was Google FINRA exam and went from there, okay? So now I go here, I go to the FINRA exam, and I type in, I basically Googled FINRA SIE exam, found practice, went here. This is the screen I'm looking for. And then I hit take practice test now. It's not timed. And boom, here comes the questions. Here is question numero uno. Okay, I think we got some of these already, but we'll go through them again. Under a system of statutory voting, a common stockholder has as many votes for each vacancy on the board of directors as the number of, okay. So remember this. Statutory voting, you get 1 vote per share per board seat. You got to use them that way. Or not use them, but you lose them. If you do cumulative voting, you get 1 vote per board seat per share, but you can use them any way you want. So you can say, like, say there's 100 shares, 3 board seats, and you do statutory, well, you can do 100 votes per board seat. And if you don't vote for the third person, then you lose that vote. But cumulative, 3 board seats, you technically get 300 votes that you can use any way you want. You can use 200 on one. Maybe you like this board member and she looks strong. You vote 2 on her and then 1 on another. You can still do 100 each, or you can do 300 on one and none on the other. So under a system of statutory voting, a common stockholder has as many votes for each vacancy as the number of shares owned by the stockholder. That better be the answer. Okay. On to number 2. Roth 401k and Roth individual retirement account plans share which of the following features? So when I hear Roth, I know that everything is done after tax. Contributions are always after tax, and they grow tax-free, the greatest thing ever invented in the history of Wall Street. So let's start with the bottom. Qualified distributions are excluded from federal tax. Yes, you don't pay tax on it. Neither account is subject to early distribution penalties. No, you do. If you take it out, you're going to have to pay penalties, okay? Roth 401k, you can actually take your own money out beforehand, okay? Neither account has maximum contribution limits. That's not true. They do. You can only put in $6,000 on the IRA. And contributions are made pre-tax. That's not true. It's done after tax. So let's go. A, contributions are made pre-tax, out. Neither account has maximum contribution limits. That's not true. At least the Roth has one, and the Roth 401k has a larger one. Like it's $18,000 now. Neither account is subject to early distribution penalties. Well, there are ways to take it out of the Roth IRA, not the Roth 401k before 59.5. And D, qualified distributions are excluded from federal income tax. That is a true statement. Okay. No-load mutual funds may have lower expense ratios than load mutual funds for which of the following reasons? No-load funds do not charge 12B1 fees. So we have to come back to that. No-load funds are not permitted to charge a 12B1 fee greater than 25 basis points or 0.25%. Sales charges for load mutual funds increase your annual expense ratio. That's not true. Sales charges have nothing to do with expense ratio. Sales charge is what it costs you to go into the fund. It's like the cover charge at a bar. Okay, fund management fees for no-load funds are always lower. No, that investment advisor, he's charging management fees. He's charging them. Doesn't matter. Okay. Let's go. No-load funds do not charge. Yes, they do charge, but they have a max of 0.25%. So that's what it is. They can't charge more than 0.25%, which is 25 basis points. Okay. Which of the following statements is true about Treasury stock? Okay, so Treasury stock, what is it? I am a company. I issue shares, and then I buy them back. So I issue 1 million shares. I buy back 200,000. To get outstanding, I do the issued minus Treasury. So if I issue 1 million, and then I buy back 200,000, I leave 800,000. Okay, So if anyone has questions, if you're seeing this and you can log in and ask, go ahead, because I want to see if it works anyway. So which of the following statements is true about Treasury stock? It has voting rights? No, it's Treasury stock. They bought it back. The company bought it back. It's almost retired. It received dividends? No, it doesn't receive dividends. That's one of the reasons they kick it back. C, it is issued stock that has been subsequently reacquired. That's a fancy word for bought back by the corporation. It is authorized stock that has not been issued and held in the corporate's treasury. That sounds awesome, but it's not the answer. C is it. So let's make sure we got it. I'm a company. I go public with my tutoring company, Capital Advantage. I authorize shares. I authorize like 20 million, but then I issue like 5 million. And then I issue the 5 million. I go, you know what? I want to buy some back. I buy back 1 million. So if I issue 5, I authorize 20, doesn't really matter. It's a random number. I issue 5, I buy back 1 million, that's treasury. I leave 4 million outstanding. So remember, outstanding is always issued minus treasury. So the answer here is treasury stock has been issued at some point. And we're super slow with my internet. Must be dial-up. Okay. Which of the following Form U4 reportable events results in an SD or statutory disqualification? I've done this one, but I would do it again. Personal bankruptcy filing. Nope, that's okay. You can do it. We don't like it, and you have to report it, but it's not. You're not going to be kicked out. Written complaints. Alleging. Alleging means you're not convicted. They're just saying you might have done it. Boom. We don't. That's not SD. Reportable, but not statutory disqualification. A felony charge. While I want to know if you killed someone or committed some sort of felony, it's not enough to have FINRA kick you out. I may not want you here, but FINRA won't disqualify you for 10 years. D, felony conviction for driving under the influence, DUI charge, ding, ding, ding. That's the answer. Felony conviction. So it's any felony conviction in the last 10 years, no matter what it is, and any misdemeanor, securities-related misdemeanor conviction charges don't matter. They matter, but they won't kick you out. The call provision of a bond stipulates which of the following. What's a call? Call is when the company buys back bonds, and usually they do that when interest rates drop because they can issue rates at a lower, they can issue new bonds at a lower rate and save money. Kind of like when you have a credit card at 15% and you can get an 8%, you're going to borrow at 8 to pay off the 15. That's what companies do. So is it going to list a maturity date? No, because they're calling it. It's not going to get that far. Call date and call price? Maybe. Original issue discount? No, that doesn't make sense. Or coupon rate and the call rate. Again, the call date's fine, but the coupon rate we don't need. So the answer is B, call date and call price. The date we're calling it and how much we're paying you. Just understand, usually they pay you like maybe $20, $30 or $50 over par. Good. Regular way settlement bonds on treasury bonds is T+1. So all treasuries trade T+1. So treasuries and options trade T+1. Everything else is T+2. Makes it very easy. T+1 is tomorrow, which is next business day. Love it. Okay. Which of the following actions is required when a firm receives cash in excess of 10 grand from one customer in one business day? So if either cash goes in, cash or cash equivalents like money orders, goes into the firm or out of the firm, you have to file a CTR. SARS, that's if they do something wrong, you're screwing the guy's life up. A cash transfer receipt sounds wonderful, but you probably should give a receipt, but that's not the answer. You don't hold their money. You file a currency transaction report, and they do. That's not a bad thing. That happens all the time. You do tell them about it. You do not tell your customer if you file a SARS. If you think he's wiring money to somebody in a bad country or something like that, and you think he's doing something bad, you don't tell the customer. You just send up a red flag to your boss, and they decide if to file a SARS or not, but you never tell the customer. The redemption value of an open-end investment company's shares is based on the previous offering price? No, because that's less. Remember, if you do a mutual fund and you buy it, it's priced at the next pricing, which is always around 4:15 or so. So as long as you buy it before 4 p.m., you get that days. If you try to place an order after 4, you're going to find out it's the next day. So previous offering price? No. Previous closing NAV? No. NAV computed after the order is received? Boom, that's going to be the answer. offering price computed. No. So it's basically the NAV. So when you buy mutual funds, you buy at the NAV plus a sales charge, and you redeem back at NAV. There's no sales charge when you redeem. So when you buy it at NAV plus a sales charge. This NAV is calculated after you put the order in. So the answer is going to be C as in Charlie. Under industry regulations, an initial purchase of $3,000 of common stock in a margin account requires a cash deposit of. Okay. So if we remember, kiddies, class, margin is 50%. So I have to put down 50%, which would be $1,500. Whoa, hold the horses. Wait a second. There's another rule. If I'm going to use margin, I have to put down more than 50% if it's under $2,000. So the minimum I have to put down is $2,000. Little fake out there. So usually I have to put down 50%, but if it's less than $2,000, I have to put down $2,000. Now, if I'm buying stock and I buy less than $2,000 worth of stock, they're not going to make me put down $2,000. So if I buy $800 worth of stock, put down $800. Okay. If I buy $2,500, I put down $2,000. So on buying between 0 and 2,000, I put down 100%. From $2,000 to $4,000, I put down $2,000. From $4,000 and up, I put down half. Now this is also initial. If it's an existing margin account, you assume that they've already met the $2,000. Which of the following security types provides investors with a stated maturity date, a floating interest rate, and an option to put the security back to a financial intermediary on a daily or weekly basis? So floating stated maturity date, so it's a bond. Floating interest rate, so it's variable. And I have the right. So in crazy words, you're saying you buy a bond that has a floating rate, a variable rate that you can sell back to the company whenever you want at par. So equity put option. No, that gives you right to sell stock, but it's not the bond. Perpetual preferred. Never heard of that, but they're preferred. They do not have a maturity date, so they are perpetual. I've never heard of it called being perpetual. But a preferred stock does last forever. There's no maturity date. A tax-deferred variable annuity has nothing to do with this. So a VRDN or VRDO is the same thing. Variable rate, the rate moves with current rates. And the demand part means at any point you can sell it back to the issuer at par. That may be called an embedded put option. So we're going to go with C as in Charlie. Okay. Which of the following statements is true regarding a customer account held as tenants in common? Okay, so there's rights to survivorship where each person gets 100% ownership, and when I die, you get it, or you die, I get it. Tenants in common. You have 40 grand, I have 60 grand in there. I die, it goes to my estate. You die, it goes to your estate. It doesn't cross over. So tenants in common. Owners must equally share. They don't have to be equal. They can be disproportionate. The ownership of the decedent's assets is governed by their will or state law. Oh, we'll come back to that. Tenants in common is permitted for use for only 2. That's not true. You can have 3 or 4. You just have to have the percentages. Tenants in common is permitted for use only for married couples or family members. Again, not true. You can have 3, 4. You can have 2 brothers, 2 friends, boyfriend, girlfriend, boyfriend, boyfriend, whatever. The ownership of a decedent's assets is governed by their will. So basically, I have 60 grand in my account. You have the other 40. I die, it goes to my estate, and the will or the state law decides where my money goes after that. But as far as you're concerned, it goes to the heirs. So the answer is B as in boy. Upon expiration, all in the money. In the money means that if it's a call, the price is above the strike. If it's a put, it's below the strike. It has nothing to do with your premium. Don't make it about you. Upon expiration, all in the money S&P 100 index call options are settled by the delivery of which of the following? Do you give cash? We'll come back to that. Do you give S&P index stocks? No, you're not getting stocks. Do you get an ETF? No, it's not an ETF option. The same number of S&P puts? No, they have nothing to do with each other. So remember, puts and calls are different animals. They just sound similar. So if you have an index option and you exercise it, the buyer is going to get cash. The seller has to give him the cash. And it's the in-the-money amount at the close on that day. The answer is A as in apple. Under FINRA rules, non-cash compensation connected with the sale of variable contracts includes all the following items except. I screwed this up the first time and I was so mad. So I looked, they're saying non-cash compensation except. So gifts, not cash. Meals, not cash. Food. Happy. You guys don't want to pay me in food. I'm happy. Lodging, you give me a place to stay. I'm happy too. So commissions are paid in cash. So that's going to be the answer. That's a cash compensation. Which of the following comparisons best describes the essential difference between primary distribution and secondary? I think I had this one and the other one. A primary can only be made for equity issues? No. Primary distribution can only be made for issues that exceed a specified dollar? No. Primary distribution must be made at a fixed public offering price? No. A primary distribution involves the sale of newly issued shares by the issuer. That's true. So primary means the issuer is selling their shares. And a secondary involves, like, let's say you have Microsoft selling their shares. That's a primary. But if Bill Gates wants to sell some of his shares, that's a secondary. You can do it through an offering. Because remember, if he doesn't do it through an offering, since he's a control person, he has to follow 144 rules. Look it up. The answer is D as in David, because a primary involves newly issued shares. A secondary is shares that are already out there, but sold by someone like an insider or control person. D is the answer. A married couple earned income that exceeded 300 grand in each of their prior 2 years and is reasonably expects the same for the current yield. Are they qualified? No. Qualified is a whole different story. That's on the 66. Are they accredited? Yes, because what's accredited? 200 grand a year single, happy. 300 grand a year if they're married or unhappy. I'm just kidding. Or they have $1 million net worth. They always say liquid in the book, but it's $1 million net worth. So that would work. They make 300 grand a year as a couple. They're fine. An institutional investor? No, institutions are not breathing, living human beings. That's like broker dealers, hedge funds, mutual funds, stuff like that. And a quib, that's for 144A. Quibs are qualified institutional buyers, which are institutions, not individuals, that manage at least 100 million. So like Bill Gates is not a quib. The Bill and Melinda Gates Foundation is, because they manage billions, but the actual individuals are not. So here the answer for accredited investor would be B. Remember, 1, 2, 3 accredited, 1 million, 200, 300 accredited. Which of the following communications with the public is considered misleading? Okay, so which one's basically lying to the guy? Historical illustrations based on fact. Okay, we can show where it's been. Product comparisons that illustrate differences. Yes, that's factual. Research report that includes a buy recommendation for a specific security. Yeah, that's fine. We can say, listen, we think you should buy it. Research people do that. D, literature providing a 10-year performance information to support predictions. You can't predict future. No predicting the future. You even have to say past performance does not indicate future. You cannot predict the future. You can say, I think you should buy it, and I think there's a target, but you cannot predict the future. So the answer is D. That's misleading. A broker-dealer is permitted to accept payments for a new issue from a customer when, okay, you can't. So prior to the effective date, that's a 20-day review. You can take indications of interest, issue a red herring, which is another one as word for preliminary prospectus, registered in the States, and take indications of interest, which I think I said. So the only time you can take an order or money is after it's effective. Boom. So that's A. D is you can't do anything during the cooling off. B and C are kind of the same thing. And A is the answer. And remember, SEC, no regulator ever approves anything ever. Okay? No regulator ever approves anything ever. Okay. Boom. Registration is effective. Effective is the word. Which of the following investments are generally traded according to their average life rather than their stated maturity dates? Okay, so corporate bonds are quoted yield to maturity or price. So that's a maturity date. Government bonds, same thing. Fixed rate capital securities, I have no idea what that is. It's probably a preferred. Asset-backed securities, that's their funny way of saying mortgage-backed securities, which they have prepay and extension risk, and you don't actually know when they're going to end. Okay, good stuff. The answer to that is asset-backed securities. If it actually would go, there we go. So corporate bonds have maturity date, government bonds have a maturity date, and fixed rates, they're preferreds. They might just have a price. But here, asset-backed is basically their word of saying mortgage-backed, which you do by the average life rather than the stated maturity date. An associated person who is not registered is permitted to engage in which of the following activities? Basically, get in my coffee. Sorry. Accept an unsolicited customer order. Provide account opening forms to a new customer. Discuss the attributes. No freaking way. Pre-qualify. No. They can basically just do administrative work. So until you pass this exam and the 7, you basically can talk to customers about their paperwork and get me coffee. I am totally kidding. I'm not being that much of a jerk, but I take it black. Okay, so now you can provide account opening forms to a new customer. That's it. Hope I'm right on that. The last transaction in XYZ 5.5%, or C 5.5S means percentage. That's the coupon. So it's paying a coupon. Was at 102. That means it's 102% of par, which is really 1,020. Just add a 0 to the end. That bond is selling at A. Is it above or below? It is above. So that's a premium. Love it, guys. Good job. Okay. The computation of dollar prices and accrued interest on muni bonds is normally done on what calendar basis? So remember this, munis and corporates are 30, 360, and T plus 2. Treasuries are actual day, 365, T plus 1. So boom, the answer is A. Don't waste a lot of time on this one. These are the gimmies you have to get right. Which of the following represents the effect of a stock split? Price per share increases? No, because there's more shares. The price per share of the common decreases? That might be true. Because remember, it's a zero-sum game. If you get more shares in a stock split, you have more shares, but they're worth less. B is probably the answer. C and D, your ownership never changes, so that's out. It's a zero-sum game. Remember, if they double your shares, they're doubling everyone else's shares. You just own the same. You just own twice as many shares, but there's twice as many shares outstanding. So I almost hit the wrong button. So the price per share decreases. When is interest on Treasury notes paid? Okay. So bills are paid at maturity, notes and bonds are paid semi-annually, strips are paid at maturity, tips are paid semi-annually. So interest is usually semi-annual, dividends are almost always quarterly. So here, Treasury notes is the bond that's Treasury that runs 2 to 10 years, so it's semi-annual. What is the cost basis of an inherited mutual fund? I screw this up every freaking time, and I always forget. So I assume that if you inherit something, you're going to get the cost basis of when the person died. So I'm going to say it's the A. So I just say whenever somebody dies, you're going to get the NAV or the cost basis of when they died. So my example, you buy stock at 20, it's up at 40, I die. You're going to get it at 40, not 20. So you pay taxes from 40 up, not 20 up. Love it. I hope I'm right. Which of the following outcomes are possible for the writer of a covered call? Okay, so if I write a covered call, I have unlimited loss, so let's find that. So it's either B or D, and I can only make the premium because whenever you sell something, you make what you got. That's it. Okay? So the answer here is profit limited and loss unlimited. If I bought a call, it'd be profit unlimited, loss limited. Good. You want puts? Buy less. A registered rep wants to participate in a PST, private securities transaction. Which of the following actions must the RR take? Okay. Request a meeting to lay out the structure. That's a good start. Call a supervisor, inform of the deal and my potential involvement. Okay, that's a good start also. Send written notice. Written notice to the supervisor telling what you're doing in compensation. And initiate paperwork required by the policy of the firm once the activity is. You don't start after. D is saying you tell them after. No, you don't do that. The old, instead of asking permission to apologize, that doesn't work with broker dealers. So what a guy at FINRA once told me, if it's not in writing, it didn't happen. Hope I'm right. If I don't get 100 on this would be pretty embarrassing. Okay. A customer is an officer of a company that is involved in some significant changes. All the following items are examples of corporate affairs that could be considered inside information if the customer shares them, except. So, pending transactions, you can't tell somebody about something that's going to happen. Declare dividend, well, they declared it, so that's totally fine. They already told, it's declared, it's public knowledge. Top management changes, well, you can't do that. Like if Steve Jobs is leaving, you can't tell people because they'd short the stock. And imminent liquidity problems, well, that's also coming true and it's not public. So what would be the answer? Since it's an except, A is wrong, C is wrong, D is wrong. I'm going to go with B because it's already declared. In which of the following situations is an employee of a public company permitted to trade upon information without violating insider laws? So you all can read this. I'll give you a couple seconds to read it because I'm stuttering. Okay, so reread this. If not, just press pause. Okay. So an independent security analyst explains to employees why the earnings could be market report. That sounds okay. That's what research guys do. So look, B, the employee works for the government. Oh, that's kind of bad. He said they're going to get a major contract. That's insider trading. He works in corporate headquarters and shares a conversation overheard regarding an acquisition. No, that's bad. And D, basically key developments in a class action lawsuit. That's bad too. So here the why A is okay is because an analyst just saying using his own analysis trying to figure stuff out, and it's a guess. So A is okay. At the time of issuance, which of the following securities has the longest period to expiration? Okay, rights. That's what you get when you own shares and they want to issue more. They're like short term, 30 days. Options are max 9 months. Warrants can be perpetual, but they're usually like 2 to 7 years, and repos are overnight. So here, a right is short term. It's 30 days or so. It's what you get when you own shares. If they issue new shares, it's just their way of letting you have the right to buy new shares, but it's very short term. Options, go watch a video on that. They're 9 months. Warrants can be forever. The answer will be warrants. When a broker-dealer charges a commission on a securities transaction, it is acted as, okay, remember ABC, agent broker commission, or PDM, principal dealer markup. So if I'm charging a commission, I am el agento. I brought out my inner beta O'Rourke there. If a market maker posts a quote of 10 by 10, 10, 25 by 10, which of the following actions is the market maker willing to take? I did this on the other video. You can find it. I'm going to tell you that he wants to buy 2,500 shares at 10 and sell 1,000 at 10.10. That may save us some time. Okay. Which of the following responses describes an advantage of index funds? Protection of principal? Nah, not really. High turnover to take advantage of market opportunities. We'll come back to that. Higher management fees? No, because an index fund is just trying to match the index. They're passive. They're not trying to beat it where you pay some guy who lives in a really rich area around you to manage it. So it's going to be lower management fees because it's passive. Index funds are passive. Mutual funds and closed-end funds have active managers, so high fees. ETFs and index funds have low management fees, so it was there passively managed. Okay, savings account at a bank. So bank, remember, bank is FDIC, broker-dealers is SIPC. FDIC covers in case the bank goes out of business. SIPC covers if the broker-dealer. They're asking bank, we're going to go with FDIC. I love it. FinCEN accomplishes its mission to safeguard the financial system from the abuses of financial crime, including terrorist financing and money laundering, by enforcing, not SEC regulations, because that's the SEC and FINRA doing that. The Act of 33, again, that's SEC and FINRA. The Investment Company Act of 40, again, that's SEC and FINRA. So the Bank Secrecy Act. The Bank Secrecy Act is where you have to, you have to get the information. You can't share anything. You have the FinCEN reports and all that, SARS. Okay, so Bank Secrecy Act. Okay, a registered rep is reviewing the following portfolio. You can see this. Which of the following risk is inherent? So which risk is in this portfolio? Well, it's not bonds, so we throw credit out. I don't see any foreign stuff, so you throw political out. So it's either liquidity or non-systematic. Now, systemic is whole market risk. That's everything. You can't diversify that away. Non-systemic or systematic, they call it, is when you buy in one industry or a couple industries, you have a lot of that risk. So here's the thing. This risk, I had a tough time with this because I don't 100% agree with it. But they're saying basically you have almost 60% of the portfolio in 2 industries, 2 stocks. So you have non-systemic risk. Because if they go sour, you're in a lot of trouble. So non-systemic risk is when you're not diversified enough. Which of the following statements is true about all U.S. government agencies? Okay. Are they exempt from federal taxes? No, because there's only 7 things exempt from all federal, any kind of taxes. Bills, notes, T's, treasuries, bills, notes, bonds, tips, and strips. They're exempt from state taxes, but they're subject to federal. And munis, geos, and revenues, which are munis, are exempt from federal, but may or may not state. So agencies are not one of those 7 that I just mentioned. So they're exempt from federal taxes, out. They're exempt from registration, that's actually true. So Act of 33 requires corporations to register their shares. So they're issued in bearer form? No, nobody does that anymore. And their general obligations of federal government? No, that would be the treasuries. So these are exempt from the Act of 33. I hope this is helping. Which of the following statements is true regarding the concept of an annuity contract? Okay, I'll probably screw this one up. Payouts of an investment in a non-qualified annuity are all income tax free. Well, that's not true. They're taxed on the growth only, not fully taxed. Okay. And the kind of annuity selected partly determines the payment amount to the annuity. Okay, we'll come back to that. In the case of a life annuity contracts, the age and sex of the annuitant do not affect the payment amounts. The problem is that's actually true, but we're going to come back to that. They do affect it because your life expectancy. The amount of the periodic payments to the annuitant are determined. Now, it doesn't change it. What they're saying, I think, is that their age and sex don't change the payments going on. It just sets up where you start. The amount of the periodic payments to the annuitant are determined by the performance of the insurance company's investment returns. So I always have a tough time between B and D. I'm going to get this wrong. I know it. The amounts of the periodic payments to the annuitant are determined by the performance of the insurance company's investment returns. I'm going to go with B because technically it's the insurance company's separate account that matters, not how the company invests in general. So I'm going to say the kind of annuity selected partly determines the payment amount, because if you choose variable or you choose life only, straight life, or life with period certain, this can affect it. I may be wrong on this, but let's move on. Which of the following products is adversely impacted if the issuer's credit rating is downgraded? Okay, so credit rating is always debt. If you hear credit rating, it's always debt, debt, debt. Okay, so mutual funds is not debt. Move on. UIT is not debt. It's a packaged product. Move on. ETFs, those are equities. It's like a little mutual fund, not affected. Ooh, exchange traded notes. I hear the word note. Note means bond. Bond means it's credit debt. That means it has credit rating. So ETNs, even though they're based on the market, your return is based on the market. Market is your risk, but credit is your biggest one. Call protection is most valuable. This one got me too. Call protection is most valuable to a bond owner when prices are generally. Everyone always thinks we're talking about rates. Okay. Call protection is most valuable to a bondholder when bond prices are generally. Now, it's when rates are going down. When rates are going down, prices are going up. So when rates are going down is when the issuer would call the bond. So rates are going down means prices are rising. So usually this is a tricky one. Everyone jumps on falling because they read quick. Speed kills on this test. So they're saying when prices are rising, rates are falling, that's when bond would be done. Under 144A, an issuer of restricted stock is permitted to sell to which of the following investors? Institutions, and maybe accredited, no. Quibs, boom. 144A is about quibs. 144A is quibs. Okay. Just remember that 144A, you can sell to quibs. Qualified institutional buyers, institutions that manage over 100 million. To offer its shareholders a privilege to obtain its shares at a fixed price, which of the following products does a corporation issue? To offer its shareholders a privilege to obtain its shares at a fixed price, which of the following products does a corporation issue? So we're letting our current shareholders the right to buy more shares. That's going to be rights. Because again, if I issue more shares, I'm going to give my current shareholders the first right to buy shares at a little discount from where I'm issuing it, so they can keep their percentage ownership. Customer buys an ABC Gen 35 put for premium 3 and also buys stock at 35. What's the break even? Okay, I'm going to give you a little secret here. Whenever if you have buy stock in an option or sell stock in an option, stock in an option, it's always going to be stock plus or minus premium. Stock plus or minus premium. The way you know it's plus or minus is if it's 2 buys or 2 sells, you add. If it's a buy and a sell, you subtract. So here, you bought 100 shares at 35 and you bought a put. So you're going to add 35 plus 3 is 38. That's the answer. Don't get that wrong. That'll absolutely be on the exam. Company announces a tender offer to its shareholders who intend to buy a max of 1 million shares. So their offer, you can read this. I'll give you a couple seconds to read it. Okay. You read this. They're basically saying, I want to buy 1,000 shares. I'm going to tender 1,000 shares into this. Okay. At the end of the offer period, this company's only bought 900,000, but they want 1 million. So you want 1,000 shares? Sure, they'll buy 1,000. There's no problem there. They're trying to trick you because if it's oversubscribed, like say they wanted to buy 900,000 and 1 million have already been tendered, then you would only get 90%. But here, since they're willing to buy another 100,000 shares, you're well within you'll get your shares. So basically, it's a tender offer. Is a company or somebody offering to buy your shares. You can end up at a set price. So if you want to sell your shares, you tender your shares into them, and then they buy them from you. In the event of a stock split, which of the following parties is required to maintain a record of shareholders eligible to receive the additional shares? So DTC, no. The issuer doesn't. Yeah, they kind of do, but they don't do it. Custodian, no. It's going to be the transfer agent. It better be. If I'm wrong, I'll be highly mad. Okay. Which of the following investment risks is the greatest risk in a variable? So a variable life insurance policy invests in the market, which means they have market risk. Boom, market risk. Variable is market risk. Fixed is inflation. But here's the thing. A is debt risk. Credit is debt risk. Interest rate risk is debt risk. Inflation is fixed annuity and debt risk. But this isn't fixed. It's a variable with market risk. Sorry if I'm going fast. Just the way I think. The owner of which of the following products is the most exposed to inflation? So inflation is the rising price of goods over a long time. So the answer is going to be, which is the longest term? Treasury bonds. Here's another thing. Stocks. Common stock is the best inflation fighting tool there is. So A and D are out. Bills are short term. They have really no risk. So it has to be bonds. Long-term bonds have more inflation risk than others. Which of the following actions violates FINRA rules regarding selling away? Selling away is when you do securities transactions away from the broker-dealer without their permission. So recommending a customer the services of another broker-dealer, you can do that. You're just a shitty customer, shitty broker, shitty employee. Sharing commissions with another registered rep in the same broker-dealer, totally fine as long as everyone knows. Advising customers to buy mutual funds below a breakpoint or a discount level, that's called breakpoint selling. It is a violation, but it's not selling away. D, engaging in private securities transactions without written prior consent to the applying broker-dealer. Again, that's doing transactions without permission and not on their books and records. So that's a no-no, and that's selling away. At issue, which of the following debt securities mature in 1 year or less? So they're asking which one's a money market. So Fannie Mae bonds and Ginnie Mae bonds are up to 30 years. Treasury notes are 2 to 10. Money markets are short term. There we go. Money markets, technically the definition is debt under a year or a year or less. Stability in the value of a debt portfolio is greatest when? So volatility, remember, long-term bonds move more than short-term bonds. So long-term bonds have more interest rate risk and are more volatile. So short-term bonds are better. Okay. Interest rates are rising or falling. It's moving. Maturities of debt securities that are long means it's very volatile. Short term, baby. I might actually do this whole thing. Which of the following stakeholders has first claim priority in a Chapter 11? I might screw this up because I don't know what administrative claim holders is, but I'm not gonna pick it just because I don't know what it is. So it always goes secured, unsecured, preferred, common. Preferred and common are both considered equity. So it's secured, unsecured, preferred, common. So it goes secured, then unsecured, then equity holders. I don't know what administrative claim holders are, but I'm going to go with secured because that's what I know. Under the Act of 33, registration is required for which of the following securities? So let's go through this. Eurodollar bonds, they're done in another country. Don't need the 33. Muni securities, they're issued by a government. They're exempt. ADRs, they're foreign securities trading here. So the securities trading here part means they have to be registered. And federal government securities don't have to register. Remember, these are exempt. Look up your exempt lists. Governments, munis, banks, common carriers, utilities, commercial paper, short ones. Reg D, Reg A, those are all exempt. They don't have to register. So I'm going to go ADRs. In a period of low inflation and economic recession, the Federal Reserve is expected to take which of the following actions? So not a lot of inflation, and we're not doing so well. So they're going to try to increase the money supply. They're going to try to make it nicer out there. So what we're going to do is we're going to make it, let's see, so decreased taxes would be really nice, but the Federal Reserve doesn't do taxes. The government does. That's why if you watch the debates over the next 6 months, they'll be talking about taxes at some point. Raise the federal funds rate. No, we're not raising rates to make it more expensive. Buy bonds in the open market. Well, that might be because if they buy bonds from the banks, then the banks have more money to spend. So they can lower rates. We require banks to increase reserves. I can't read. That means the banks have to have more money on hand. They won't do that because that again makes it harder. So during a recession or contraction, the Federal Reserve will lower rates and buy treasuries. During expansion, they will raise rates and sell treasuries. So we're going to buy bonds. UTMA accounts are opened under the tax ID of the, it's always under the minor. UTMA is under the minor. UGMA is under the minor. The custodian manages it, and the custodian actually writes a check for the taxes, but the responsibility for the taxes is on the minor. Under FINRA rules, which of the following activities by an RR requires written notification to a firm? Volunteering, nobody cares. Gambling, well, it's good for you, you gamble, but you don't have to let them know. Driving part-time, ooh, that's a job. So yes, you have to let them know about a job. You don't need permission, you just need a job. Different firms, remember something. There's FINRA rules and house rules. FINRA rules say you don't need permission. Most big broker-dealers will require you have permission to have a job. Selling non-proprietary investment company securities through her firm. She did it through her firm, so nobody cares. That's totally fine. That's not her job. Okay. So it's going to be C if you have a job. I must click the wrong one. A decline in the GDP must last for how many quarters to be a recession? So if you use Kaplan, or I think Notman does it too, they try to say downward is recession. No, a recession, contraction is GDP going down. Going down for 2 quarters is a recession. Going down for 6 quarters is a depression. Or as my friend always said, a recession is when my neighbor's out of a job. A depression is when I'm out of a job. Ha, ha, ha. So it's going to be 2 quarters. Sorry. Corny Joe says it dead joke. A member of a stock exchange responsible for providing liquidity in a security by being willing to buy and sell at all times is known as, okay. A broker, yeah, they don't really have to do that. They're just jobs. That's what you guys are going to be. Brokers, you deal with customers and you just help recommend. An underwriter, underwriters help bring companies public. Okay, a market maker, that's what they do. A market maker has to be willing to buy and sell all day long. And a transfer agent is just a clerk who keeps track of everything. It's an important clerk, but he's a clerk. So the answer is a market maker, because market makers have to be willing to buy and sell from 9:30 to 4 all day long. And reasonable to the inside market. A firm is a participant in a public offering to sell a substantial amount of securities to its customer. The firm agrees to repurchase the shares at no less than original sales prices. Now, I would say this is not okay because you're guaranteeing against a loss. So let's just go straight up with A. If it's anything other than that, I will be very upset. But this is what the answer is. If you're willing to buy the shares, if you say buy my shares, but I promise to buy them from you no less than where you bought them, you are guaranteeing against a loss, which is a big no-no. So that should be a no. The primary purchase of a syndicate desk, I got this wrong the first time. The primary purchase of a syndicate desk in the context of an equity offering is to, see, I said C originally. Solicit interest from investors in the stock offering. I thought that's what they do, and they kind of do. But they're saying they build an order book and allocate the shares. So they build the order book and then they allocate the stock to different people. So there you go. Under Reg SP, which of the following information must a firm include in its customer privacy and opt-out notices? Okay, so they're saying that You have to put in there that I'm going to keep your information private. I'm not going to give it away, sell it, any of that crap, which who knows what they do. Okay. You don't have to put on the customer privacy. You don't need the address. You don't need the fee to opt out because there isn't a fee to opt out. And there's really not a deadline. You can opt out anytime. The answer is you have to give the answers. God, I sound great. The answer is the policies to protect the security of the non-public information. You just have to show them that you have a policy in place. Like same thing with the BCP, business continuity. You just have to tell them that you have one. You don't have to give them the names. It's not on this question. I'm just saying BCP, a lot of these programs, you just have to let them know that you have one and they can see that. Customer has a cash balance in her account together with long positions in several securities. She has made no securities transactions in the account during the last 18 months. How often should she get her account statement? Okay. If there's activity, monthly. If there's no activity, quarterly. Or if it's penny stocks in the account, you have to do monthly. So activity or penny stocks, monthly. No activity, no penny stocks, quarterly. Which of the following actions is required of a broker-dealer's anti-money laundering program? Okay. All these are great. You just have to have someone in charge who's going to be in charge of it. So you have to have an AML compliance officer. That's the big one. Okay, that's required. Everything, you don't file with FINRA. You do have to conduct background checks, but FINRA just started doing that for you. And then identifying to regulators, the employees responsible for the CTR. You will have to do that at some point, but that is not up to FINRA. When selling a fixed amount of a base currency to purchase a counter currency, which of the following factors is primarily used to determine how much of the counter currency the customer will receive? Okay, first of all, the credit rating, don't care. The trade balance between the two countries, that's too massive. The counter currency inflation rate, no, we don't care. It's basically the spot exchange rate. It's basically the rate that it's being exchanged at right now. An investor owns 100 shares of XYZ common at the market price of 50. They do a 1-for-2 reverse split. So you're getting 1 for every 2 you own. The investor's post-split stock position, say that 10 times fast, will be, let's see, so we owned 100 shares at 50, so now we're going to own less shares for more. So we're going to own 50 shares because it's half, and since it's 1-for-2, it's double. So it's going to go up. So it's going to be less shares more. And the only one that gives you less shares worth more is B. A lot of times they give it to you that way. Blue sky laws, just remember, blue skies are for the states, baby. So that's state regulators. SEC is federal. MSRB actually doesn't enforce anything. They just write rules. FINRA is for broker-dealers and exchanges. So blue sky laws are regulated by the state administrators. That's your next exam. Well, after the SAE and the top off, you either have the 63 or the 66, which covers that. Under normal circumstances, a customer's letter of intent is valid for what? You just got to know this. Letter of intent is 13 months, but remember, you can backdate it 3 months, but then it only goes forward 10. It's a max of 13. So and I'm moving my arms, which you can't see. If I backdate 3 months, then I can only go forward 10. So letter of intent, and a letter of intent is saying, I'm going to invest $5,000 now, but I think over the next, my Aunt Becky's really sick and she's going to die, so she's going to leave me money. I'm going to use that money too. So you can say, I'm going to put in $5,000 now. I'm getting $20,000 from Aunt Becky when she kicks it. Somebody, you put that in. So let's pretend I put in $25,000. Give me the breakpoint discount based on 25, not the original. That's what a letter of intent does. It's not binding, so it's always suitable. DPPs provide, okay, they're not liquid, they're not correlated to the market, and they're not buying stock. So this is the tough one. It's just exposure to non-correlated. Correlated means it works with the market. Non-correlated means it's something different, and it gives steady returns. It can. That's its stretch. But if you buy like a real estate limited partnership, you might get rents passing right through to you. So the answer here is B. Broker-dealer ABC seeks to underwrite a muni securities offering by a local town. A muni MFP who resides in the town and works for ABC contributed $200 to the mayor's re-election 13 months ago. It's not about the years, it's about the election. If the employee wants to support the campaign further without hurting, you can give up to $250 per election. So if you have a primary, you can give $250, and if it's a general, you can give $250. but max is 250. But if you're married, your husband or wife, if you write a check and you both sign the check, you can give up to $500 because then it's half. But remember, if you only sign the check, then the entire check is attributed to you. So you got to get your hubby or lovey wifey to sign the check. In the over-the-counter market, the term spread refers to, okay, so the spread is the difference between the bid and the ask. So that's what it is, the bid and the ask. That's it. Spread on the underwriting is the difference between what the issuer gets and what they sell it to and the underwriter sells it to the public. All the following risks apply to both foreign and domestic. Okay, so let's see. So interest rate risk, yes, everything is interest rate risk. Repayment risk, yeah, that could be true because it's refinancing or call risk. Political risk, yeah, everything is political risk because even our country can get screwed up. Exchange risk. The only time you have exchange risk is if you invest outside the country. So the domestic stuff doesn't have it. Under Reg T, a 90-day restriction is opposed when a customer does what they call free riding, when they buy something and don't pay for it. Okay? So same stock, same day margin account? Nope. That's a day trade. Same stock, different accounts, same day? Same stock in different accounts in the same household? Again, these are just day trades. Same stock in a cash account without paying for the stock in full. If you do a cash account, you pay for everything. If you don't pay for it within T+4, not T+2, T+2 is settlement, T+4 is payment. If you T+4, you have to, if you don't pay for it, then you get, if you get an extension, that's great. If you don't, they freeze you for 90 days, which just means, it's not a big deal. It just means whenever you buy stock, the money has to be in the account before you place the order. Which of the following considerations should a registered rep explain to a customer when recommending a 529? Again, I screw this up all the time. Since it's a municipal, it's going to be, bottom line is it's whether state taxes get undone. It's always exempt from federal. Well, the distribution part is. Income eligibility, there's no income lift, and there's no age limit. So C and D are out. I always torn between A and B. Let's go with A for the heck of it. Maybe I get one wrong. I announce a 20% stock dividend. That means anyone who owns shares is going to get 20% more stock. So if I own 1,000, I'm getting 1,200. Boom, there it is. Now the question is, zero-sum game. If I get more shares, they have to be worth less. So it has to go down to 41.67. But if you really want to know the number, the way to do this one, 1,000 times 50 is 50 grand. That number is going to be the same. So if you have 1,000 shares and you get another 200, you now have 1,200. If you do 50,000 divided by the new amount, 1,200, you will get the answer 41.67. A transaction which a writer, so writer means I sold it. So writer means it's an opening sale. I sold it, and then I bought the option back. So it's, I always follow an opening sale with a closing purchase. Opening sale, closing purchase. If I have an opening purchase, I follow it with a closing sale. I almost clicked the wrong one. There's going to be a closing purchase. An RR who wants to place a mutual fund advertisement must obtain written approval from which of the following parties? Okay, first of all, regulators don't approve shit. FINRA, no, out. State Securities Administrator, out. The SEC, out. So it's going to be the principal approves. Okay, so I finished. Uh-oh, let's hope I passed. Oh, I got one wrong. What did I get wrong? See, look at this. What did I click? I told you I get wrong. Where is it? See, I'm honest. Can you all guess which one I got wrong? Oh, I pressed the wrong. Covered call. I screwed this up. See what happens? Speed kills. I'm going to go over this. You probably all saw me do it. A covered call means I own stock and sold a call. I'm an idiot. I buy stock and sell a call, so I can't make money on the upside too much, and I can lose money on the downside. So it is limited on both sides. An uncovered call, unlimited loss, limited profit. A covered call, you're limiting your upside and your downside. There we go. I wonder if any of you got that. If you did, please let me know if you got it before I did. So see, remember, speed kills. You never want to do anything fast because you get one wrong. Okay. I'm very happy with that. I did okay. I think it didn't take me all that long. I hope you guys didn't put you all to sleep. I am heading out now, trying to get some sleep, and I will see you at another time. Have a good night. Have a good Saturday. I'm glad I ruined your Saturday. I'm kidding.